What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Welcome back to another episode of the CPA Zone. This is the podcast where I break down tax talk for real estate investors and small business owners and try to make it understandable and relatable to what's going on with you, and hopefully a little bit entertaining. I'm your host, Ryan Pulis. Today, we're going to dive into fix and flips. So it sounds simple. Buy low, rehab, sell high, cash out. However, as with every business venture out there, Uncle Sam has a seat at the table too. So let's talk about how fix and flips are taxed, how to set it up appropriately to help minimize your tax and avoid common pitfalls. So gotta get started with just how they're taxed in general. So fix and flips are not passive income. You know, I know you've seen the HGTV shows, looks like easy money, but really in the eyes of the IRS, flipping is considered an active trade or business. That comes with a totally different set of tax treatment rules than your long-term rental passive investments. So what does that mean? It means profits from your fix and flip projects. They're still taxed as ordinary income, not capital gains. There are factors we've covered on previous podcasts where you could list the factors that you can use to differentiate whether your project is capital gains versus ordinary income or active trade investment or active business income versus passive investment income. And generally, it's going to be things like the frequency you're doing it, what your original intent was when you bought the property. That's huge. That's one of the big ones. If your original intent was to rehab and flip it, then it's a flip ordinary income. If it's to hold for investment, then it's capital gains. Anyway, there's a whole list of them. I recommend checking out that previous podcast episode to get down in the weeds on that. So in short, if you thought your fix and flips were just going to generate a nice 15% long-term capital gains rate, that's probably not going to be the case. Generally looking at ordinary income tax rates, which could go up to 37% federal, depending on your tax bracket. And that's not all. If you're flipping, then you are also likely paying self-employment tax. So that's another 15.3% on top of your regular income for the Social Security and Medicare. So it really adds up fast. Let's just say you make a $50,000 profit on a flip. You're in the 24% federal bracket, add 15.3% for the self-employment tax, and now you're almost at 40% just on federal taxes. That's 40% of your profit. So almost $20,000 of your 50 going to the IRS before you even consider state taxes. So depending where you are, that's another 5 to 13%. Now, don't worry, we're going to talk a bit about strategy now. So let's first discuss entity structure and why that matters. So with fix and flips and entity structure, it could really be your secret weapon, especially when it comes to the self-employment taxes. And that's why we typically recommend running your fix and flip business through an S corporation or an LLC that makes an S election to the election to be taxed as an S corporation. So that's going to help limit your self-employment taxes. Okay, so with an S corp, you have to pay yourself a reasonable salary. So that portion is subject to payroll taxes, the Social Security and Medicare. We've been referring to self-employment taxes. But then the remaining profits are going to be paid to in the form of distributions, which are not subject to self-employment tax. So we use that same $50,000 example with an S corp. Let's say maybe you decide reasonable salary is $30,000. Yes, you're going to pay the self-employment taxes on that, but the remaining $20,000 is going to be left over taxed only as ordinary income. It escapes that 15.3% self-employment tax. So that move alone on this particular example, it's about $3,000 in taxes on one flip. You multiply that by a few projects and you can talk about real money here. Now, some common mistakes that we see flippers make is, well, one, just using an LLC with no S election. So they're kind of exposing their entire profits to the self-employment taxes. You don't want to leave money on the table. And maybe if you're doing just a one-off deal and the profit's not really substantial, that's fine. You stay with a single member LLC. But if you're doing this for the long haul and you're good at it, making good money, really want to consider that S election. The second thing is you hold flips for too long and then try calling them an investment. So you're really looking again at that intent. And the intent is effective to sell quickly. That's inventory. It's not investment property. So it means you're really in this dealer status mode. You're not going to get the capital gains treatment or depreciation. So when it's inventory, you're not depreciating those assets. You're holding them in inventory until you sell them. Then that cost gets released in the form of cost of goods sold or cost of sales. The third thing is mixing your flipping and rental properties or holding them in the same entity. So flipping that's your active business income. Rental income's passive. Mixing them up can screw up your bookkeeping, your tax reporting, and potentially even your liability protection. So you want to keep your flips and your rentals in separate entities. Doing that also, because if you're flipping on a regular basis and you own rental properties, the IRS is going to assume that all of your properties are for sale inventory. Having a separate entity, like this is my entity over here for rental properties, that's a point in your favor to demonstrate, hey, this really is a long-term investment asset. It's not part of my inventory over here, subject to ordinary income and self-employment taxes. Okay. You want to keep those entities separate. Just before we wrap up, just a few other tips to keep your flipping business running smoothly is just track all your expenses, your rehab costs, contractor fees, all of that stuff. Track that in an accounting system. If you're running a flipping business, don't try doing this in Excel. You end up missing so much if you're not very careful. It's worth what add on whatever QuickBooks costs a month. There's other systems out there that you can use as an alternative to QuickBooks that are a bit cheaper, but you definitely want to get an accounting system in place, one that produces an income statement and a balance sheet. Make sure it does both, not just a P&L. Make sure you hire a pro when you're ready to start going right from the beginning. Don't wait till after you sold a property to get a CPA in place for this. By that time, you're already starting down. I might be looking at a surprise tax bill. And don't wait until April 15th to find out you owe taxes on your flip income. You should be running an estimate, kind of projecting income out. Make sure whether you need to be paying quarterly estimates or not. And again, this kind of goes back to the separate entities, but also use a separate bank account for your flip business. If you have separate LLCs, great. You should already have a separate bank account. If you're doing everything in your personal name, really consider that as corporation first. But if you're not, make sure you're at least using a separate bank account for your flips and your rentals. But again, I would highly recommend separate business entities and then using the S corporation for your flips. So that about does it for today. Main takeaways: flipping houses. It's great. It could be a really profitable strategy. But if you don't structure it right, you're going to end up sending more money to the IRS than you need to. That about does it for today's episode. If you found value in this episode, just do me a favor, subscribe, leave a review, share it with a fellow investor. Until next time, have a great day. Are you interested in becoming a client? Click the Discovery Meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.